Thank you for joining this webinar. Vital Transformation Consortium, including Pfizer, the U.S. Chamber of Commerce, and MedTrack by Informa, investigated the relationship between public funding and private investment into new innovative therapies and the supporting system of intellectual property. I'm very pleased to discuss this research with you, and I'm going to be joined by three colleagues who worked with us on the course of this project. The first is Patricia Giglio from MedTrack Informa. She's the content manager there. Good morning, Patricia. How are you?
Good morning. I'm well, thank you. Hello, everyone.
Thank you for joining us. And also Patrick Kilbride, the Senior Vice President of GIPSI, the Global Innovation Policy Center of the U.S. Chamber. Good morning, Patrick. How are you, sir?
Hello, Dwayne. Thanks for having me back.
Great to have you here, Patrick. And of course, Eva Groot-Andal, the Vice President of European Government Affairs at Pfizer. And good morning, Eva. How are you?
Good morning. I'm very well, Dwayne, and good morning, everyone.
Thank you for joining us, all of you. So to begin, just quickly, you notice many of you have probably joined our webinars before, and we've used a different tool. This is our first outing with the new tool. So just to walk you through some of the tools at your disposal, if you're having audio connections, please feel free to switch between your computer audio and the phone. We've provided several dozen phone numbers. This tool in particular is very robust with international telephone numbers. So please feel free if you're having issues. You just push on the little join audio button, that little box pops up and you can switch, and then you have lots of options for different phone numbers. As well, we will be taking questions from those of you who are joining us in the final half hour. There's a little Q&A button on your menu, on your tool. And if you push that Q&A button, a little box will pop up and you can submit questions to us, and we look forward to receiving those. So just to begin and to kick off, IP supports an ecosystem where investors are willing to lose everything 92% of the time in order to fund the 8% of medicines that succeed. Now, I know this sounds quite anodyne, and maybe you know this, but the fact is failure in drug development is normal. It is the standard operating procedure, and most investors lose all of their investment over 90% of the time. And I think this is really important to drive home when we're talking about IP incentives. We're currently in the course of the incentives review in Europe. The orphan drug legislation is under review. And we need to be cognizant of the fact that anything we do with IP needs to support a system where an investor is willing to invest in that 253rd Alzheimer's drug when 252 drugs before have failed. That is the ecosystem, and we really need to keep that in mind because that is really what this is about. So what we did is we wanted to investigate how all of this fits together. So we looked at all the EU biotech startups from the period of 2001 to 2007 in the UK, Netherlands, Belgium, and Spain. And we only looked at those companies developing medicinal products, drugs for human consumption, not diagnostics, devices, cosmetics, agriculture, green bio, and nothing like that. We really only wanted to look at those things that come through the regulatory process at EMA and then go to the member state HTAs. We really wanted to look at EU biotech, high growth, high investment, high-intensity innovation biotech. And then we wanted to look at the impact of various funding streams. Now, the first is an initial public offering, an IPO. I know it has IPO there. It has nothing to do with IP. Basically, an initial public offering is a listing on a stock market. It's how you can get money. You can go to the market and people invest and buy stocks, and it's one way people invest in a company and create value and support an innovative industry. Private investors, that includes industry sponsorship, venture capital, angel investing, as well as direct funding and direct EU funding, I should say. So these are the Horizon 2020 programs, IMI, Framework 7, Framework 6 in particular. And we wanted to look at those funding streams and their impact on success or failure. So we looked at success from the standpoint of status. Are the products being moved successfully through a pipeline? Do we see progress through a clinical research pipeline? We looked at it from the company's ability to be successfully moving new products through research. So it's a going concern. They're successfully funding what they need to do from phase 1 to phase 2. They've had licensing, they've had products be approved, or at least they've had products approved in their clinical trials, they've registered clinical trials, they've published results, they're moving forward, and or the company was bought wholesale at a value increase. So these are what we consider success criteria. Not a success, ceases to trade, goes broke, files bankruptcy, shuts down. Or it's a zombie company. And what we see in a lot of the data, and I'd say this is probably the majority of the companies we looked at, they're companies that have had a phase 1 clinical trial. They've raised, $1 million, $2 million. They've proved that there's safety, which is a phase 1 trial. It looks at safety, but then they stall and they can't get enough funding raised to phase 2. That's the majority of the companies, and that's usually where they fail. Or it's a zombie company. They've done a successful phase 1 and they say, hey, we're going to raise money and do phase 2, and then you see nothing for 4 years. Or they've done a phase 2 and then they don't publish results. So that's a zombie where we see no activity. A major failure of lead product, if it's a biotech and they've got one asset and that fails and then you don't see anything for 3 years, again, that's a failure. And then an acquisition at a loss. They just give up the ghost. They say, okay, we're shutting down, go back to academia. So those are sort of the statuses that we see from success and failure. So the study sources, MedTrack was our main source, and Patricia will be walking you through that as soon as I get done here. We also did a deep dive into the annual reports, and this is why we chose the Netherlands, Spain, Belgium, and the UK, because it's very easy to get an audit trail and have access to their financial data so we could verify things. Clinicaltrials.gov and the Clinical Register of the EU, these are all the listed clinical trials. We looked at those. We also looked for publicity, press releases. Are they planning on raising money? Are they announcing a phase 2 trial? Do we see a gap in their activity? And then we also looked at the EU Cordis database, and that's the database for IMI, Framework, Horizon 2020, Framework 6, Framework 7, etc. Just to be clear, we looked grant by grant, company by company, over a 7-year period. That was a painstaking process, ladies and gentlemen, but I'm very grateful for Dr. Anna Ludlow of VT's team who did a lot of the grunt work on that, and she did an excellent job, and her thanks as well deserved. So, the nuts and bolts, folks, here we are. We had 116 companies we analyzed. 65 were in the UK, that's the largest population. 22 in Spain, 20 in the Netherlands, and 9 in Belgium. Obviously, Belgium being the smallest country, we would expect that. What do we see? The UK is about a 50-50. Companies are succeeding and companies that are failing. Spain had the highest failure rate per capita. The Netherlands and Belgium, the Brits have a wonderful expression. They box clever. It seems the Netherlands and Belgium really dedicate their assets on those companies that have the highest probability of success, which is very interesting. So if you look at things like what you have at here in Belgium, you have several incubators, particularly those in Ghent. We did an interview with Johan Cardoon in our podcast series. I highly recommend you listen to that. So you see that you have these really good infrastructures around them, and that does pay dividends. So here's the total amount invested for our entire 119 population cohort. What you see is $30 billion in US dollars. Were invested through venture capital, angel, and licensing. So that's $30 billion. Only $1.2 billion came through stock market listings or initial public offerings, the IPOs. And the Cordis database yielded 61 million in funding from EU projects. So we're really talking an order of magnitude of about 500. So you really see the difference here. Really, we see a ton of private funding, and that's really what moves the bar and helps companies succeed. A successful average company has about 400 million, 405 million. Now that belies a certain amount of skew because a few companies, it's a very, very few, as we know, only 92% will succeed. So you see that there are $6 billion companies, there are $4 billion companies, there are $1 billion companies that are significant outliers. So this is a skewed data set in that it does have a right skew for those companies that are more successful in getting later and later into the pipeline to aggregate and gobble up the vast majority of the assets. But you do see even here, between failing companies and successful companies, a very large dispersion in the amount of funding that they create. So the market is already acting on those companies. You can see that the market and the investors, the private investors in particular, are being very choosy with where they put their assets. And you can see there's already a sort of winnowing out of those assets that have market potential and those don't. And what's interesting, and we'll investigate this correlation later, is you also see a similar activity in the EU. Now, granted, EU funding is at an order of magnitude smaller, but you already see that 700,000 per company versus 33,000 or 330,000, excuse me, for companies that aren't succeeding. So you see 3 times the money going to those successful companies from the EU databases than you do for the failing companies, which is, again, interesting. So the EU also behaves similar to how the private market behaves. And again, we'll discuss that in more in depth in a bit. So what drives success? What we wanted to do was look at these companies that were succeeding and those that were failing. And then we wanted to throw variables at the model. And then we were going to see if that had statistical significance. So we took the companies successfully, lined them up, and then we took the companies that were failing, we lined them up, and then we put them in what's called a logistic regression that allowed us to do hypothesis tests on what were the impact of success or failure. So what you see here, this is the first output, and you can see, I'll pull my mouse up here. You can see these companies here. These are the successful companies that did an IPO. And you'll see these are the failing companies that did an IPO. There's a concentration. You'll see this consistently. You'll see there is a concentration of companies here on the baseline at 0, the small companies. And then as you get out, the numbers get bigger. So this is 50 million, 100 million, 200 million, 300 million. 450 million. And you see here, this sits roughly at 50%. It goes up to a little over 60, 65%. So really you're at someone flipping a quarter here. So the IPO does not have statistical significance. To look for statistically significant impact, we would expect to see a p-value of around 0.05. And all that means statistically is that there's a 5% chance that money is impacting success. We don't see that. Right now it's about 50-50. So we cannot reject the null hypothesis that money does not impact success or failure. We reject that because we can't say that it does statistically. Now, look at here what we have. This is the private funding aggregated together. So this is total private and IPO per firm. Now, what do you see here? You see this line getting sucked up to the success and sort of sticking to it like glue. And you see, again, this huge concentration of companies here under $1 billion, as you would expect. And then as you go forward, you see the numbers go up and you see the success rate fitting to a p-value of 1%. So that means there's a 99% chance 99% chance statistically that these populations are different. And the thing that's different is the amount of investment. This is a very strong statistical result. And what it shows is that we can predict the success of a company by the amount of private funding it receives. So here, if you were to draw a line at 800 million, you'd end up at about 80% success. So this is a very interesting result, and it does show quite conclusively with very strong statistics that money does predict success in a biotech firm. So really it is the private money that is deciding if this is a success or a failure. Now, we ran the same test with EU grant money. So this is, again, the funding we found from the Cordis database of the European Commission. And you see here, again, the concentration of companies under $1 billion. And then you see the skew for those companies that do succeed. And what you see, there's an impact and a correlation here. We see a relationship, but the statistics are not statistically significant. We don't see significance here. Now, this is interesting, and this was a result we wanted to dig into because we also saw in that earlier slide that the EU grant money does seem to coagulate and gather around companies that have a higher success rate. So we tried running the statistics and we were having a lot of difficulty finding anything. It was actually quite messy. And what we realized was that the UK, not only is it the largest amount of quantity of firms we analyzed, it was almost half the data set, but what it also has is the least amount of EU funding per company. So this was creating a large amount of noise in our data set. So we couldn't really make any firm conclusions with the UK in. And what we realized when we ran the probability statistics, when we pulled the UK out, is it reduced the noise and we got very tight regression statistics. So what we decided to do was test the ability and the correlation between private money and EU money. And this was not part of the original scope. This was strictly dictated by the results and the data that we were being delivered. So it was really an opportunistic research. And frankly, it was quite amazing what we got here in this result. What this model says, and it's an exponential regression, obviously nothing we're dealing with here is linear because of the size of the skew of the data and the amount of funding. So again, you see a high concentration again around 0, but as this goes up, what you see is a very strong ability to use the amount of private money to predict the amount of EU grant money that is given. In fact, this is the strongest statistic. There is 1 in 1,000 chance that this is not a valid statistic. This is a very, very strong statistical relationship. And what this says is we have a 1 in 1,000 ability to predict the amount of EU funding that will be given based on the amount of funding that the private market gives. In other words, the EU follows the private market in making its investment decisions. Now, as a EU taxpayer myself, this I find really fascinating, and I also find it very powerful, because what it says is the EU is actually being very wise with how it invests its money, which is, I think, from a taxpayer perspective, a really good result and a very interesting result. Again, completely unexpected, not even in our thesis scope, which Patrick and Ava will certainly tell you. This was never anything we wanted to look into, and it certainly runs contrary to the current narrative that we've been hearing in Europe. What it says is Europe also responds to the ability of these products to be a success. And again, that's a good thing. We want our money being invested in places where there's a chance of success. So for the cynics out there, I'm sure if we removed the UK because it caused noise in the data, what happens if we then test government money and the ability of EU funding to predict success if the UK is removed from the data set? And I understand that. So we wanted to be very transparent. We said, okay, let's go back and test that statistic. And actually, this is worse than when we tested it with the UK in. So it actually creates an even messier statistic. So it's a worse result. So we can say conclusively that EU funding, no matter how we slice it in our data set, does not impact success statistically. Why does all this matter? And I've got just a couple minutes left here. Why does all this matter? Well, what we see here, and we've been tracking since 2015, the global biotech acquisition market. So these are mature biotech assets, and who's been buying them. And we started this project in 2015 with the European Biopharmaceutical Association, EBE, and we've been keeping it up ever since. And what you see is last year in 2017, calendar 2017, 70% of all mature assets were acquired by the United States. And that includes a lot of European assets. Now, why is this? If we think back to our IPO and our initial public offering, and we also see that Europe is highly, highly concentrated in private investors, and we don't have an IPO market. The fact is those private investors need an exit vehicle to get their return on investment. So let's say the company is successful, it is moving forward. They need to get out of that investment somehow and pay back their investors. How do they do that? Well, there's no IPO vehicle in Europe, obviously, as we saw from our data. What's interesting is in the US in 2017, when I presented at the Gastein conference that really started this whole thing, this whole research project, I showed a data set from the University of San Diego that said, without question, the #1 success factor at the University of San Diego's biotech cluster for the San Diego environment, for the companies in San Diego, was their ability to raise money through an IPO. The size of the initial public offering was the #1 guarantor of success in San Diego. We see the exact opposite in Europe. We see no statistical impact. Thus, the only avenue that private investors have in order to be able to get their return on investment is a sale. Either A, moving the company to the US and listing as a US company on the US markets, which we do see a lot of, or B, selling outright to US corporations. And then those corporations pick up the asset ball and run with it. So unless Europe starts focusing on its IPO market and starts developing a more liquid stock market, this will continue. And it's only going to get worse and more challenging, both A, with the Brexit and the UK stock market leaving the European community, and B, also because essentially you have competition coming in from China, Asia, Singapore, Korea. This is going to get harder and harder. So this is really important. Again, let me just conclude here saying that the total private funding given to a firm is statistically significant to the success probability. Initial public offerings do not impact the success of EU firms, and this doesn't matter if it's an IPO in Europe or the US. EU firms do not get the money they need as an EU firm on stock markets. They only do it if they move to the US, frankly. This is probably a substantial part of the reason why they're leaving the EU and being bought. Given funding directly to a firm does not impact the success rate. EU funding does not impact the success rate of an individual firm with certainty. EU funding given directly to a firm can be predicted with certainty by the total amount of private investments given to a firm. Private investments predict levels of EU funding. And again, that's a really unique finding that was unexpected. Ultimately, the market decides which firms will be successful. It's a allocation asset vehicle. The market decides which products are going to succeed and which products are going to fail. And impacting the ability of people to take risk and get a possibility of a fair market return is going to stop that person from investing in the 253rd Alzheimer's drug when they know that 252 have failed before. So that's my message. Thank you for listening. And now I think it's really important that Patricia walks us through the data set that we worked with, MedTrack. Patricia, thank you very much, and the floor is yours.
Good morning. So I would like to kind of follow on to what Dwayne has talked about and discuss the data used in the research a bit. Okay, so just a little background on MedTrack. So the data used in the research presented was analyzed from MedTrack, which is a business intelligence provider that takes a comprehensive look at the global pharma and biotech business landscape. We analyze all types of companies, from small startups to key players in the industry on a global scale, and we monitor the investments and partnership agreements, the financials of the companies, the drug development pipelines, the sales and patents to gain insight into the trends and opportunities available. So this type of company and drug information supports various functions such as market research and building market models, competitive intelligence, new discoveries and trends in drug development, licensing and investment opportunities, and finally, R&D spending patterns. Company coverage is global in scope, as I had mentioned, and it tracks the activities of healthcare players that focus on pharma and biotech, med devices, CROs, and about a dozen additional sectors. However, as Dwayne described earlier, only companies developing human therapeutics were used in this analysis. Information like news, investments, development pipelines are monitored in real time. We also follow the statuses of the companies and their progression over time. In terms of deals, all deals and investments are captured, such as partnership agreements, mergers and acquisitions, IPOs, venture financings, and even private placements. Financial terms, when they are disclosed in the public domain, include total deal values, milestone and royalty payments, and again, they are monitored and updated as they become available. The news we capture is indexed based on the company's drug types, IP, and geographic location, so analysis can be made in a streamlined process. In terms of products, we take a comprehensive look at all aspects of drug development, from preclinical through commercialization. Worldwide patent coverage begins in phase 1 and is curated from individual country patent offices. Historical and forecasted sales based on analyst consensus estimates are also reported. And finally, to round out the market research in the industry, we have incidence and prevalence information for the 5 EU, US, and Japan with population-based projections for forecasting. So how do we get this information? Well, we employ a rigorous editorial process that involves 3 major steps: daily scanning and reviewing of thousands of company sources and news outlets, SEC filings, and earnings reports. Drug sources include trial registries, regulatory agencies, and scientific meetings and journals. And then once the data is captured, our team of in-house analysts review the information for new and updated intelligence related to the companies, the drugs, or the deals, and then disseminate the data to the MedTrack platform following a quality assurance review. Additionally, each company and drug record undergoes a comprehensive periodic review. And so that is a summary of how investments and developments within the pharma biotech space are monitored and reported in MedTrack.
Thank you very much, Patricia. Do you have a regional focus in one way or another, or do you feel that you're strong everywhere?
I think we're as strong as we can be globally. Of course, some news outlets may be a little more, forthcoming with information in certain areas of the world, but our reach is as global as we can be.
Yeah, that's great. And again, just to let everyone know, we use the MedTrack database to do our research, and the data was very deep and rich, and we're very grateful for your participation and support of the project, Patricia. And obviously it was a really compelling result, and we're thankful for that. Thank you. So Patrick Kilbride. Patrick is going to join us now from the U.S. Chamber of Commerce's GIPSY. Patrick, can you, from your perspective, see how you're looking at the global IP market right now and some of the debates that are going on globally, and particularly with Europe?
Thanks, Dwayne. Great to be back with you. Really enjoyed our podcast on the Vital Transformation website, and looking forward to talking again today. So first of all, when we talk about intellectual property rights, what we're really talking about is allocating resources to risky endeavors. You started by talking about 92% of all drugs entering clinical trials failing. Well, why would investors want to put their money in an area with a 92% failure rate? The only reason it can happen is when the laws and the opportunities on the back end are sufficient to enable a return on investment. And that's where intellectual property comes in, because it provides a path to an eventual return on investment. And so when we talk about intellectual property, ultimately what we're really talking about is financing. And the good news there is that this is what Europe and the United States are really good at. You know, we have built our economies on the basis of our ability to bring private sector capital off the sidelines and into productive investments. And that doesn't mean just, you know, wealthy investors who have bags of money lying around. It means everyday people like you and I, who, you know, have a few dollars that we want to save for our children's educations or our retirement. We have, you know, public pension funds that want to be able to sustain, you know, their investment in the retirement of their employees. And so when we can put all of this money into a productive allocation, then that benefits society. And when we can encourage risk-taking in an area like biopharmaceutical innovation that otherwise would be impossible to happen, then that provides a tremendous benefit to society.
That's great, Patrick. And you've also been heavily involved, I know, in the SPC debate that's been going on. Obviously, that's not the scope here. Do you want to just touch on that from your perspective of your members about how you think that's going in Europe?
Thanks, Dwayne. That's a great question. You know, and the concern here, the European Commission has proposed an amendment to its own laws to provide a waiver from the supplementary protection certificate, which basically says that if an innovator is denied the full term of protection because of bureaucratic delays, that they can get back some of that time. Why it's important is because it sends a really important signal about where intellectual property rights in Europe are headed. And for all the reasons we've just discussed, you know, the amount of capital necessary to bring a new medicine to market, the length of time it takes, and most importantly, the high degree of risk, it's absolutely critical to the market psychology that governments are sending the right signals. Providing a waiver for this SPC, which would allow generics to come on the market faster in third-party countries, really sends the wrong signal for investors in Europe, and would really only, you would expect that to accelerate the flight of startups to the United States, where, you know, the rules are a little bit more reliable right now, or appear to be more reliable. But Dwayne, I do want to spend just a second talking about that, because I think it's important when we look at that statistic you showed of U.S. companies buying European IP.
Yeah.
Well, what does that mean? You know, on the one hand, you could say, well, this is all bad for Europe, right? Our brilliant scientists are discovering, you know, the basis for new cures, and then the U.S. companies are snatching them up. I think there's a more positive way to look at that, which is, were it not for a U.S. market where there was sufficient investment capital and liquidity to scale up these operations, the EU biotech startup community may not be sustainable. So in effect, that U.S. capital market is sustaining the base level investment in Europe. Now, does that mean that we don't have a problem that we should address in terms of seeing European companies capitalized at home? No, that really ought to be a priority for Europe as well. And it begins with shoring up its historical commitment to intellectual property, so that companies can stay at home and invest with the confidence that their ownership rights will be viable in Europe.
No, that's great, Patrick. And I think it's time to bring Eva Groot Andal in. Hello, Eva. Thanks for joining us.
Hello. Thank you.
And I'd like to
I was on mute.
no problem. So Eva and Patrick and Patricia, just dealing a little bit on what you were just saying, picking up on some of your points there, Patrick. What do we think would be the appropriate role for government funding in R&D? I mean, where do we see that line? What should be the role, and how can we get that balance right? Let me start with you, Ava. What do you think? What do you think that role should be?
Yeah, thank you, Dwayne, for the question. Well, so clearly your research has shown, as you just said, that private money predicts public money. But, each stakeholder do bring resources and unique expertise into the sort of research ecosystem, with governments providing both funding for basic research and regulatory oversight, to ensure new medicines are shown to both be safe and efficacious. Academic research centers also play a role and around primarily conducting basic research. And I think for us, the pharmaceutical and biotechnology companies, we're also conducting basic research, but validating disease targets and then identifying potential therapies through clinical trials. And that's translating the basic foundational science into biomedical treatment. So I think there's a role for, government, academic research, and pharmaceutical companies, but it's certainly not the government that's, picking the winners in the R&D space.
No, agreed. Now, Patrick, I'd like to touch on a point you made when you were talking about the current situation globally. You mentioned the investment of pension funds, and that's a big part of the U.S. market. Unfortunately, many European countries aren't allowed by law to invest in biotech. It's actually banned. Do you have any data from the U.S. perspective about how much impact that actually has on IP broadly?
Well, I mean, yeah, as you pointed out, as a player in U.S. financial markets, the public pension funds are tremendous. And I don't have a specific data point on that, but I think it's easily accessible. And the fact is that what the United States and Europe have done really well over the last several hundred years is mobilize money, not just public money. And we see, around the world, the source of most basic research and R&D funding comes from the public sector. That's not true of Europe and the United States. The private sector drives a lot of that. In fact, in the United States, we've seen that over time, where the government used to do the majority of basic research, today it's less than 50%. So you're seeing a bigger role for the private sector at very early stages. On the follow-up to that, in the commercial product development and commercialization stage, the private sector has always led. And in the United States, according to the National Science Foundation, 2/3 to 3/4 of all research and development is funded or carried out by the private sector. So what you really see is an important early stage investment by governments, which I think is important for a couple of reasons. One, it helps governments, pick areas where it wants to prioritize for societal benefit. So that could include things like orphan drugs, rare diseases. So there's an ability to point the private sector in the right direction. The second thing is that, in the United States at least, there is a conscious effort at de-risking. And so what you see at the very early stages is, for instance, at the National Institutes for Health in the United States, an attempt to weed out, some promising areas of drug development from those that just don't look as good. And so there's a conscious effort to sort of set up some opportunities that look more promising, where universities and the private sector can then pick it up and run with it. But as you said, while that is a very valuable contribution, it is just the beginning and not the end at all of drug discovery and development. The private sector role is absolutely indispensable.
That's a key point, Patrick. Patricia, just out of curiosity, if we were trying to look at pension fund investments between Europe and the U.S., would you guys cover that? Would that data be there?
Not necessarily. It would depend on the circumstances. as I mentioned earlier, we try to cover all the investments within the industry, but of course there are certain limitations, qualifications as far as which companies would be germane to the information that we provide. But for the most part, I think you can kind of get a good idea, so to speak, of what is going on and the partnerships that do exist between those entities.
Yeah. We've got a question here from Hilda Stevens. Thank you very much. Just a comment. She says, it would be interesting to compare the research data with the same data resulting from research funding, both private and EU and other sectors. That's a very good point. We're happy to do it, Hilda, if you got the funding. Thank you very much. Just another question here that we've had come in. Is it possible to fund R&D without the market? What are possible alternative models? That's a really interesting question. Eva, what do you think? Is it possible to fund it without a market?
I don't think so. I don't think it is. I mean, as we've seen from your research, and I think we know R&D is a very costly enterprise, including attrition. I think it exceeds 2 billion. And so public funding is just a fraction of that. And you need private money and expertise to take an asset through the development process. And actually one example that comes to mind, as we have seen with research and development for antibiotics, where we had not had a new class of antibiotics for gram-negative bacteria licensed since the 60s, or a new class of antibiotics gram-positive bacteria, if the commercial market isn't sustainable, it creates significant challenges for the private sector.
Agreed. Patrick, anything to add to that?
Well, let's look at one popular idea for alternative funding, which is, prize money that could be, collected by governments or, large foundations that, would reward, in effect, an innovator for bringing a successful new treatment to market as an alternative to giving them a patent right and a period of exclusivity. And the problem that I see with those types of proposals is that they only want to fund the successes. And as you pointed out, Dwayne, 92% of the effort here results in failures. And if you don't fund the failures, you will never get the successes. And I think it's important to remember that, while that 90% failure rate represents sunk costs, it doesn't mean wasted investment. It means knowledge that we're gaining, developing, that contributes to the 8% that are going to succeed and reach the market. So it's absolutely critical that we fund the failures, that we embrace the failures, that we embrace risk and help allocate capital to risky endeavors. That's really what the system is all about.
Yeah, thank you. We've got another question here from Marcella Vieira. Thank you, Marcella. And again, this is a great point, and this goes to a lot of the issues we're having now around orphan drugs, where more and more of the research is in smaller and smaller populations, yet we're spreading the cost over a smaller and smaller target. How can we try to reduce the prices of the end products to make sure people who need them have access? Again, this is a continuing question. I suppose accelerating research and getting to market faster would be the most logical answer. Eva, any comment on that?
Yeah, I mean, certainly that would be one element of trying to make the whole process faster and less costly and time consuming. Another aspect which I think is distinct from that is, because I really do think that the IP discussion is quite distinct from the pricing issue.
Sure.
And there are lots of tools in the European environment, which is what I'm familiar with, where you're regulating prices. But acknowledging that some of these new therapies are very costly, and there's a dialogue to be had with between innovators and governments on making these products available. But I think you should separate the investment and the intellectual property that's used or necessary to drive investment, and the discussion around access and affordability and pricing, which is really a different discussion in my view.
Understood. Patrick, anything to contribute on this topic?
Just simply to always, when we think about the cost of a real innovative medicine, to take a step back and understand what the cost reflects, which is the pipeline. It's not just a single medicine. It's the ability to deliver new medicines continually, and to understand that that cost does reflect the failures as well as the successes, and that to ensure that future generations, well, even our own generation, have access to new cures, that we need to have a shared investment, a shared purpose of sustaining investment in those new medicines. And I think when we look at it through that lens, it leads to some different conclusions than, when you simply focus on the price of a dose of medicine in the short term.
Tricia, you want to jump in on the hot potato of pricing?
Well, I think the other speakers really hit the mark.
Yeah, that's fine.
Yeah.
Sorry.
Yeah. Now, I just want to add one thing maybe. I think on some of the sort of recent therapies that have been very discussed because they were expensive, at least at face value, but because you precisely have intellectual property, and that means that the science or the innovation will, be public in terms of other innovators built on that innovation, and therefore you see other products coming into that space fairly quickly. So the competition even within the patented segment actually is quite strong, and not, as we sometimes hear, you have a monopoly for a long time. That's really not the case. It really drives competition in the patent segment, and I think the hepatitis C segment is really a case in point for that.
Yeah, I mean, for those who don't know, Gilead put Sovaldi out, and obviously it was very controversial. They priced it at $84,000 when it initially hit the market. Now, as I'm sure many listening know, we did a lot of work on Sovaldi. We did a lot of health economic impact assessments. I had several quite, shall we say, public discussions on stage at very large conferences where we had some disagreement with several of the regulators. But the fact is, Sovaldi, while you were paying $84,000 over 10 years of treatment, you were reducing liver transplants, which were a 1 in 5 tail risk of anybody who had hepatitis C. And the total, and plus interferon-based treatments, the alternative pathway, are terrible. And so the actual treatment cost, if you looked at it patient by patient on average, was over $200,000 US, 150,000 euros, 135,000 pounds in the UK, according to the NHS data that we looked at. And then AbbVie came out with their competitor. And immediately, this was 18, if I'm not mistaken, Ava, 18 months afterwards? I think it was 18 months.
Yeah, very fast.
Yeah, AbbVie's combo therapy came in and the price immediately halved. So it went from 80,000 to 40,000. Now I just read an article in the NHS that the NHS has bought, basically they're doing a blanket coverage now at, $14,000 now in the NHS for, so yes, there is competition even with patents. That's 100% correct. Patrick, anything to add to that slight sojourn?
I think as we look at the ability to deliver new cures, it's also important to remember that what these medicines look like is changing so quickly. We've seen a transition from small molecules to biologics to now combined therapies, and the technology
almost a pathway treatment, if you look at the
Well, absolutely. And so, what we're seeing is the crest of a wave, and it's moving very quickly. And what we want to do above all is sustain that wave of innovation and not do anything to get in the way of, these developments that are leading to new cures. People are living today that, had a death sentence just a few years ago. We need to move this forward. And, it's easy to look at today's high prices for the very newest treatment and say this is unsustainable. But if you keep that wave of innovation moving forward, moving fast, the prices always go down after. We always find ways to make them more affordable. So key thing is keep it going.
I'd like to move on with another question here about the international competitive landscape for IP. And Patricia, rather than get in the weeds on some of these issues, hopefully we can get you in too. How is the market evolving now? I mean, 20, 30 years ago, 75% of all medicines came out of Europe. It was 50-50 a few years ago. Now we see Asia and the rise of the Asian tigers in biopharma. How is the global competitive landscape for intellectual property evolving? Patrick, you want to start with that?
I'll take this opportunity to make a shameless plug for a piece of research that the U.S. Chamber of Commerce does, which is the U.S. Chamber International IP Index. It's on our website, and the next edition comes out on February 7th. And we look at 50 economies and score them against 40, for next year, 45 indicators, looking at all forms of intellectual property. And what I'm really excited about, I'll tease it out a little bit, next year, I think you're going to see some important movement in the developing world. For a long time, we saw Europe, United States, Japan really outperforming the rest of the world by a wide margin. This year, we're starting to see movement, and I think it reflects a ground level investment in the knowledge economy in a lot of different countries, maybe beginning with the BRICS. So it's a really exciting time. I think the world is waking up to the way that intellectual property functions to enable investment in innovation and creativity. And so I'm fairly encouraged.
Ava, anything to add?
Yeah. No, I mean, I think we, as Patrick said, we have seen a rise of life science research in Asia due to policies undertaken, for instance, by China. They're creating the conditions to support a strong ecosystem. And I think, between 2000 and 2015, China increased its investment in R&D as a percentage of GDP by about 131%. And in Asia, Japan has been the regional leader. But in 2017, for the first time, industry sponsored more clinical trials in China than Japan and Korea. Wow. So definitely, China is taking very important and positive steps to strengthen its system and its attractiveness, and wanting to get this investment into China, and it's actually happening.
Patricia, are you seeing this in your data as well?
Yes, we are. So, as we talked earlier, so this innovation is driving competition, but it's also driving competition among countries. And I think China is a great example of that, where we're seeing more innovation there, more trials. It's just a matter of government regulations and how they vary among the different countries. But for sure, we're seeing it in Asia. And, maybe 5-10 years ago, it was Japan, and now the surge we're seeing in China.
So given this reality, what are the opportunities and challenges then for the U.S. and Europe? Ava, do you want to address what do we need to be concerned about, or what are the benefits and what are the potential red flags?
Yeah, well, I mean, it is a global competitive marketplace, but I want to stress that Europe should not become complacent in this whole area. Europe needs to continue having a policy environment that attracts investment, including intellectual property rights, and Europe has a very good and delicate ecosystem of rewards and incentives, which represents, an industrial policy that has been developed for Europe over a long time. And if Europe starts tinkering too much with that, with emerging markets trying to attract investment, I think we'll see a shift.
Patrick, what's your opinion from the U.S. perspective on this?
I think Ava nailed it. Where a few years ago, I was principally concerned with trying to raise standards in countries in the developing world. Today, I'm at least as much focused on trying to maintain competitiveness in the United States and Europe, and leadership from those countries where the IP system has really been fostered over many decades remains critically important. And we haven't finished the job. In the U.S. market, we've seen an increasing degree of patent uncertainty as stakeholders grapple with proliferation of patents, especially in new areas like artificial intelligence, but also biotech. We've got to get our hands around how to deal with new emerging technologies and their patent eligibility, and create a system where everyone can engage and understand what the lanes are and what the patent landscape looks like. So there's a lot more to do. But I am encouraged by the progress we've seen in a lot of different markets, including China.
And Patricia, I'm sure for you, that's just a huge growth opportunity, right? I mean, you guys.
It is,
yeah.
right, exactly. So collaboration, I think we can all agree that that's the way innovation then is moved forward, and the collaboration between multinational companies is what we're really seeing. So in addition to, striking up deals with say, universities and academics, I think that all companies are looking globally for those innovators.
Agreed. Well, we've reached the end of our time. Again, I really am very grateful for the three of you for your participation today, as well as MedTrack, the U.S. Chamber, and Pfizer's support of this research project. Obviously, it caused a bit of a stir at Gastein. It was nice to see we had 30 people on the webinar. Thank you very much for attending. We will be circulating the information out to everyone. We'll also be releasing this as part of our podcast stream. Please go to the website and download any of our information. Patricia, we circulate the PowerPoint. People can get a hold of you through that. Is the contact information in there?
Yes, I believe it is.
Okay, fantastic. Patrick, how can people reach out to you at the U.S. Chamber?
I am at pkilbride@uschamber.com. But look from the uschamber.com website. You can find more about me or the GIPC.
Thank you very much. And Ava, I'm sure you're going to be back in Europe. Have a good time in New York. Thank you for your participation.
Sure. Thank you very much, Dwayne.
Thank you. And thank you, everybody. And with that, we draw this webinar to a close. Goodbye, everyone. Thanks for your participation.